You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
And welcome to the Option Block. Who is this? No, it's not the long-winded and deep-voiced and mock turtleneck wearing Mark Longo. It's the long-winded, hooded sweatshirt, high-pitched voiced Mark Sebastian. And welcome, and we're back here. I'm guest hosting today. Mark is at an important FinTech event, and if you don't know what FinTech stands for, that is quick way of saying financial technology. And but joining me is my good friend and really getting our net average size to the average American, the wonderful Mike Tusaw.
Always good to be here and happy to keep the size up because Lord knows we don't want our average size to be below the 200 mark.
Exactly. And if it's just me, the height, the mean height and mean weight, it just is kind of scrawny, unfortunately. So, what
you lack in size, you make up for in option knowledge.
In option knowledge and in verbosity.
Can you guys hear me?
And loquaciousness.
I was always quite loquacious.
Yes, I'm known for that. So with that, let's roll out of the Hey There block and into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
And welcome to the trading block. And let's talk about the market. Well, we saw the S&P hit all-time high intraday, but it did not settle there. We settled around 21,1293, and the VIX settled 1247 with the NASDAQ hitting an all-time high and the Dow settling above 18,000. Really kind of a weak day for the Dow, mostly because of Minnesota mining and manufacturing. Apparently the Minnesota part is fine, but the mining and manufacturing not as great as it needs to be. So, Mike, what were you watching today?
Well, being a Boundary Waters fisherman, I agree. The Minnesota part is always fine for sure, anytime. But yeah, a couple things. I think I do see the S&P making the all-time high very briefly. It just touched above it for about not even a full point above the all-time high. So we did see that today. The other things that I'm noticing is that not so much today, but yesterday with the bonds pulling back like they did, they recovered a little bit today, but not too much. Apple is up a little bit. It's still below the all-time high of the 133.60 mark, but that should be interesting going into next week. Gold had a little bit of an up day. A lot of good things happening from the standpoint of the market, but once again, we need to close above the all-time high in the S&P, and we still did not do that today. So I'm looking at today's move as very cautiously optimistic. Now, I know I say that all the time, but now I really mean it from the standpoint that we're at a pivotal point right now and that we're knocking on the doors of new all-time highs. And if we start to make new all-time highs, then we could be in for a very nice bull market the rest of 2015. But this is a pretty strong level of support of resistance to get through, which we did not do today.
Yeah, well, one of the interesting things is we're near the NASDAQ composite, along with the S&P, both hit all-time highs. But people want to be like, oh, that's a sign of a market bubble or this or that. Mike, do you think how would you compare the feel of this all-time high relative to the one just before the dot-com bust?
I think this one is, you hear it on TV a lot. This has been the most hated rally in market history.
Oh, Lord, yes.
And so everyone says, oh, it's about to go, it's about to go. And so that kind of makes me think that we're going to continue to go higher, because in the dot-com era, when you and I were actually just in college, but I remember following markets back then as well. During that era, we had it to the point to where actually no, when the bubble burst, I was actually out of college at that point. But at that stage, when the NASDAQ just pulled back like 5 or 10% from the all-time highs in 2000, I still remember it. I was playing for the Chicago Rush at the time, and I remember just talking around the locker room saying, yeah, Lucent would be a great stock to get into right now. It's pulled back. Yeah, look at all these other internet stocks that we're getting into, and hopefully all the guys in the locker room, I got cut before I had any money to invest in any of them anyway, but hopefully a lot of the guys around the locker room did not do what they were talking about, because at that stage, that was back when nothing could possibly go wrong, because we were coming off of the long bull market of the 90s.
Right. Well, and another piece that's interesting now, is one, Apple is just such a big piece of the NASDAQ composite and the S&P, but really, I mean, look at the earnings and the strength of kind of the big companies of the NASDAQ composite. It's totally different than kind of the nature and structure of the composite back in the year 2000.
Totally agreed, because that was back in the day to when I think there's that Simpsons episode where Bart works for a dot-com company.
Oh, yeah, that was hilarious.
Here, we'll pay you some stock. And they just have the toilet paper roll full of stock or whatever that they gave them.
Yeah,
and
exactly.
That was basically bubblegum.com, or, we can go on for hours about all the .com companies that busted. But back then, it didn't even matter if you made money or not. Just so long if you were a .com company, there was such the tulip bulb mania style feel for it. Whereas you're right now, the big portion of the NASDAQ is Apple, which I don't know if I've ever mentioned that I've been kind of fond of that stock over the years. Maybe I've said on the show, I'm not sure, but that's a very solid company. And if you look at a lot of the other companies that make up the NASDAQ, it's a similar story. Right now, I'm still concerned with the fact that we haven't been able to break through the all-time highs, but once we break through them, if we do, which we're extremely close to them, I will jump on the bull train and be extra bullish, as opposed to right now I'm just being kind of bullish.
Yeah, I still like the market. I like the market to break potentially tomorrow. And, we've got a whole host of earnings coming out tonight. Just a massive earnings being released.
Oh, it's huge.
And,
Amazon,
it's really interesting to see how they're doing. All right. Google is currently, they announced earnings. They're up $11. Amazon, they are down 15. So, 6 of one, half dozen the other. They cancel each other out. That's been the entire pattern of this. That's been the entire pattern of this market over the past few weeks. And so, I think there's a good shot that the market can keep going higher and we could see things push. Microsoft is up $1, which in Microsoft terms is a huge move. So, of kind of the big .coms the big tech names we were watching, 2 out of 3 are up, and we touched an all-time high. So there is strength. There's real earnings in these all-time highs that really just weren't there. You look at the S&P, like, they rallied because of because of oil or because of this. And really, it's kind of the breadth of the 500 biggest companies in the world. They're just stronger and they're performing better. And so, like I said, I think that that's a quality thing to think about. Another big thing that came out, Mike, apparently one retail-based futures trader can cause the S&P 500 and the Dow to completely break. What did you think about this arrest of the e-mini trader in Britain over the week this week?
I think her response that I saw from it kind of made me laugh. We can't quite repeat it on the air, but it just kind of shows that it takes them a while to catch something like this, but I really don't know enough about it to comment as of yet, just because of the fact that this is something to where there is such a mystery about the flash crash that day. That was probably one of the for about 20 minutes. I'll never forget it. Kavanaugh and I were sitting in the office, and we thought that we were at war all of a sudden. And there was a lot at the building we were in at the time. There was hedge funds up and down the hallway. You could just hear walls pounding, people just yelling and swearing as loud as possible. Mm-hmm. I mean, it was a scary day that day for a few minutes. And it's the only time in my career that I remember we had Options Express, or Brokers Express was our broker dealer at the time. And I'll never forget, we couldn't get filled on a market order on an RUT option for one of our clients. Yep. And the market came back, and then he called back right away and said, "Did that thing by chance not fill?" I said, "It did not." He said, "Cancel it right now." So I cancel it, and it saved the guy $50,000 just out of dumb luck. And
there you go.
It was something else. And so just the fact that, number one, it takes almost 4 years for something to happen like this, it does kind of concern me about it, that the time it takes. But number two, this is interesting in that if one person can do all this, it does kind of make you scratch your head. That's for sure.
Yeah. Well, apparently this guy was, doing all these cancel and fills, but it's not like he was the first guy to come up with the idea of, kind of quote stuffing and, cancel replacing and doing things like that. I saw on Twitter a guy made a joke that he'd been doing this for 250 days. Had done this for 250 days, and he said, so of the 250 days, of the 250, what was the line? Of the 250 days he was doing this, he's responsible for all one of the flash crashes. So it just seems a little odd that this guy in particular caused this. I'm not saying he didn't contribute, but the idea that he's the only one involved seems. I'm not much into the conspiracy theory stuff, but it does feel a little bit straw manish, don't you think?
I would think so, because it's even from the 87 crash, there's still debate over what happened in the 87 crash to this day. Some people say it was program traders. Of course, the people that don't trade all blame it on the traders, saying it was those evil traders that tried to get it done. No one really knows for sure, and the system's never perfect by any means, but I think the solution to the problem ultimately is have a plan in case something like that happens, because it will happen.
Yeah. Oh, no, for sure. But, this just doesn't this all doesn't add up to me. And, I'm sure the guy is a bad dude and is certainly maybe even a contributor. But I just don't see how this guy's the only guy who is doing this.
Yeah. Initially, I would agree with you on that. I haven't read the full story as of yet. I mean, I got a little bit of it today, but initially I would definitely agree on that. That's pretty difficult.
All right. So now from flashes of crash, how about oil making cash? Oil's up was up again today. It really seems to have found a floor. Now we've got this kind of Yemeni stuff that's given oil some real problems, and the Saudi Arabia, U.S., Iranian thing is certainly putting a little bit of a floor into oil. What are you doing in crude right now?
I'm still sitting on XLE. I think this is one where if we come a little bit higher, I might start doing some type of management in terms of possibly collaring it. But for right now, I'm still just sitting on XLE. I think that I have a hard time believing that we're going to sit at the levels that we're at forever. And if we do, great. Our clients will get their dividend by paying less at the pump, so to speak. But I think we have a lot more upside to go in crude. The thing that, from a technical standpoint, I think the key number where we're at right now is the December numbers around the high 50s. And if we can break 60, I can see a lot more upside in crude. But it's kind of like where the S&P is right now with the all-time highs. We got to break through that first.
Yeah. I think I really do think this lends to the fact that oil is kind of flattening out. And, I was watching CNBC, every once in a while I'll flip it on for 15 minutes just to see what their content looks like. And, they actually, there's one guy named, I think his name's Brian something or other, and smart guy. And he got the head of of a Mexican oil giant, forget which company, to basically come out and basically say, we can make money selling oil at $25 a barrel. And if you think a Mexican, borderline state-owned oil giant can make money at $25 a barrel, how do you think an ExxonMobil or a CVX is going to do? I bet you those guys have a price point where they can make money on $20 a barrel. So some of these big diversified names that have all this drilling and can ramp up and shut down the production, I think that you look at those dividend yields and things look inexpensive. It's hard not to want to own an Exxon that has a dividend yield of pays close to 4%, or a CVX or a Conoco, any of those ones, that they start to look kind of interesting.
Yeah, I think right now, $25, I don't know if I would quite buy that they could still make money at it, but maybe, who knows? I'm not an oil baron by any means, but still, they're gonna find a way to make money. They've been at this for a long, long time. And you're right. Let's say they shut down a bunch of wells. Let's say they cut costs in one way, shape, or form. They can definitely still make money. I think that I have a lot of confidence that would be the case. And once again, it all goes back to what Mark Longo always says: we all, as Americans, are natural bearers on oil. So by owning some oil stocks or some type of a crude oil futures contract or something like that in general, just depending on what your financial situation is, I think it makes sense.
Yeah, and then there was this article on Barron's. This will be the last thing we hit here. There's an article on Barron's that about VIX. I don't know if you read through this, but how are derivative strategies making money with implied vol moves on earnings announcements? How are different teams trading, out of the money options and whatnot? I don't know if you read through that Barron's article, but, it's kind of interesting that, Goldman derivative strategies are advising clients to favor at the money options over out of the money options. That makes sense. And, that's really kind of an interesting little piece that Goldman's desk is moving in that direction. I don't know if you got a chance to look through that, but if you haven't read that article on Barron's, it's worth some time, folks.
Got it. Yeah, because one thing I found interesting is that I had a client, this wasn't one of my recommendations, but this is just kind of one thing he was doing on his own. I was talking with him yesterday, and going into the Facebook earnings, he actually sold the April 85-83 put spread. And Facebook's earnings were, I don't know how closely the listeners followed it, but as long would put it, a resounding meh, at least in the between after hours and today. And so Facebook actually, at the time he put on the trade, it was probably maybe like 10, 20 minutes before the close. Facebook was trading at 84.60 or something like that. He took in a 90-cent credit for the put spread. So $2 risk, 90-cent potential credit. So I guess technically $1.10 risk, 90-cent credit. And so Facebook came in lower today. And even though it came in lower, the fact that all the juice that was in the 85 put just got squeezed out so much, he actually got out of the trade at probably 60 cents when all was said and done. So even though he said going into the trade, he was bullish on Facebook, but he played it in such a way to where he sold the slightly in the money put, and he still got, so essentially pretty much the closest thing to at the money he could get. But it worked out because of all the volatility getting crushed that he ended up being profitable. And as Alex Jacobson would always say, you can be right on volatility and wrong on direction and still make money. And this was a real life example of that.
Yeah, I mean, and if he closed this morning, he had a real shot to cover the whole banana. There's a period where Facebook threatened $86 a share. So if the trader covered, he could have done real well.
Yeah, he got out before that. He was a chicken. He admitted that. But still, he got a little bit of a profit.
Well, good for him. Good for him. Yeah, and Mike, any other kind of things you're watching? I'm noticing Starbucks had earnings is out, and they're up nicely. And let's see, Pandora. I know you're big into Pandora.
Don't open that box.
Pandora's down a little bit, and so all of the major players, most are winning. Just Amazon and Pandora. So kind of interesting.
Yeah, and earlier this week we had McDonald's. The market liked what it heard from McDonald's, so to speak. So we had even though it didn't beat estimates, market liked it. McDonald's had a nice little rally. We had some clients in that. So you're right. It's been kind of a mixed bag with earnings thus far. And I'll tell you what, my favorite part about this market right now, Mark?
What's that?
My all-time favorite part of it is that all day as I'm looking at this and just listening to the financial media and that type of thing, you know what word I didn't hear once?
What's that?
Fed. All I hear about
nice.
is earnings and actual companies.
Yeah.
This is how it should be. I love it.
Well, and I think I think the companies did a good job sandbagging and blaming the dollar. And, the Fed's out of the picture for a while. I think people have kind of figured out there's no inflation. Why bother? So, yeah, and the other piece I think is how many times do we need to get excited for earnings season only to see the VIX at 12 before people realize that, generally speaking, earnings does not really affect the volatility of the S&P 500 at all.
Yeah, I mean, it's going to happen 4 times a year.
Yeah, absolutely. So, with this, let's roll out of the trading block and into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
And welcome to the Odd Block. This is this part of the show where I'm going to talk about a few odd trades that I've seen throughout the day. One that went up yesterday, a customer bought through the system 97,000 of the May 12.5 puts, paying 9 cents. It's a big, big order. It was a huge portion of the volume on the day in VIX, and kind of represents an odd trade. I've talked to people around, and, there's 2 ways to look at it. Is the guy making a bet on term structure? Because the VIX is right now closed here today, 1248, and this guy's along the 12.5 puts. Or is he trying to come up with a smart way to hedge? And my guess is it's more the latter. I think this is we've seen a similar order like this on 3 or 4 separate occasions. And on each of those occasions, it's been kind of near market highs. And then shortly thereafter, the market gives itself a little bit of a drop. So I think this may be a hedge against, probably a conglomerate of short positions that, that maybe are conglomerate positions that maybe net lean short delta or leans long vol. That's kind of my thought process. I don't know, Mike, what are your thoughts?
For that kind of size, I would tend to agree, because 97 is a lot of thousands, and I really wouldn't see that being just a short-term spec play. So that does seem to be more of like a longer-term hedge from where I stand as well.
Yeah. All right. Now, EWT, that's just the MSCI Taiwan Index. It was up about 50 cents. Customer bought 25,000 of the May 17 calls in EWT. Paid, call it, actually, by the end of the day, he bought 40,000 of them. I take that back. So he bought more and did a decent job of running up the vol. So this was an outright buy. Looks like he ran them from about 13 cents all the way up to 15. Now, what's interesting is that this is not, Taiwan's been moving around, but this is not the most volatile name. And, it's a $16.50 stock or ETF. That 40,000 represents almost all the open interest in the whole thing. We did see a little follow-up of some June being bought as well. the 20,000 of the Junes. So, the one thing to recognize with these names, they're not dollar hedged. So the question is, is this it's certainly a play on Taiwan doing well, but does also represent maybe some potential strength in, the Taiwanese dollar, the yuan. I don't know. Thoughts, Mike?
Well, on this, I think in general, I think now's the time to start being short bonds and short the dollar if you can handle it. In in terms of the 25,000 May 17 EWT calls, that it just to each his own in terms of size. But I think that we are going to turn at some point just because of the strong trend with which we've had for so long with both the dollar, bonds as well. I know bonds aren't relevant to this, but I think that it is a time to prepare for that. And if this is kind of something to where they're looking for strength on the other side of the dollar, then this could be a way to go. But I don't know if it's gonna quite happen that quickly. And from my standpoint, I have a longer term horizon with my thought on the dollar as well as bonds turning around. I don't think it'll necessarily happen over the course of the next 3 weeks like this person does, if indeed that's what they're thinking. But I like the direction, but I just think you need more time. And the June 17s would probably be a little bit too short term for my blood as well.
Yeah. All right. Well, with that, let's roll out of the odd block and into the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
And welcome to the mail block palooza. It's kind of like Lollapalooza, but way more fun with better music. This is a question from Vegan, and what Vegan is asking is, I want to go long as much beef as possible. No, I'm kidding. Vegan's asking, what oil products do airlines use to hedge their crude exposure? And, there is contracts on jet fuel, but for the most part, and Mike, stop me if I'm wrong, a lot of the airlines don't hedge that much. But the ones that do mostly just stick to WTI or Brent.
Yeah, I had a lot of exposure to Southwest Airlines. One of my big trades, probably about almost 10 years ago now. I feel like I'm feeling old. I had a lot of exposure to Southwest Airlines. It was like one of those. It was one of my all-time favorite wheel trades. Even though I didn't call it a wheel at the time, in terms of just buying LUV. Selling covered calls on it, because at the time that was when oil was first coming up, and I remember that was the big debate: is crude going to hit 50 or 70 first? That was always what was going on around the 2005-2006 time frame. And Southwest Airlines basically had their oil at, I forget what the price was, but they were buying their oil for like the next 4 or 5 years at like a third of the cost of where crude actually was, and that was a huge thing for them at the time. I also remember at the same time, American Airlines was saying how ridiculous that was. I remember watching the CEO of American Airlines at the time going on TV saying, well, we wanted to hedge, but none of the exchanges would let us, and we just don't want to spend the money on it. And so, with that, you know how the stocks performed over the course of the next few years and how that worked. And so my brother-in-law is actually also a pilot for American Airlines. And so I remember him going in and explaining to me, he was saying, yeah, they did like a seminar for us, and if they were going to try and do some type of hedging, because I guess that's what their pilots union had suggested to them, if they were going to do some type of hedging on crude oil, they would have to do this, and the other. And he was kind of going into how they had to do crack spreads and all these real exotic things on oil. But the reality is that a couple things that really seemed fishy to me about American Airlines was that, okay, I have the ability to, Mike Tusaw has the ability to open up a futures account and go long or short crude oil with relatively small amounts of money.
Yeah. Why
wouldn't American Airlines have that? So that was one thing that kind of concerned me when I saw the CEO of American Airlines saying that on TV. And then the second thing, it ain't that hard. There's people out there smarter than me that they could probably hire for not a lot of money that would give them advice in terms of how to hedge crude oil.
Yeah,
and you can just buy a call spread or something like that. So to answer your question, Vegan, for the most part, they do it at a different level in terms of they probably have relationships with exchanges and things like that. But bottom line is that if you want to be locked in at a price, you can just go short.
Yep.
Or go long, whatever.
Yeah. And yeah, I mean, it's been shocking that, I'm hoping that they learn their lesson and go in this time. But who knows? Yeah, I mean, I was shocked that that's been kind of the way things have worked out for, that. But yeah, crude's not that hard. I agree. And I wish people would do it. Here's a question from Nick. I've heard markets spend 30% of the time trending and 70% of the time bracketing. Can I use options to trade both of those environments? Mike?
Absolutely. But here's the key, Nick. It's your job to determine if we're in a trending market or if we are in a channeling or bracketing market. You can argue, like right now, so far in 2015, we've been in a channeling market. And it's kind of been, it's the best of times and the worst of times for me in that I really love being a bull. But on the flip side, I've been able to sell some premium to actually make a little bit of money this year for clients. So with that being said, there's strategies to determine them. So I think what you need to do, Nick, is say, okay, step one, are we in a trending market or are we in a channeling market? And then step two, what's your list of strategies? If we're in a channeling market, then maybe you can sell some short spreads of some sort. Maybe you can do some more neutral style strategies. And if we're in a trending market, then you say, okay, I'm going long options. I'm buying the farm I'm betting the farm on buying these calls or buying the puts, depending on which way your trend is going. But key is, which one are we in?
Exactly. And the answer is you don't know. You literally don't. And yeah, so that's the key. Now there are some things like, butterflies or different things like that. There are some people that'll do different things like that, but that's the key. You got to figure out what's going on. All right, here's a question from Alan, and it's, why is rolling a position so prominent? Isn't that just averaging into a losing trade?
I got this one.
Yeah, I know you got this one.
I'm convinced that the term rolling an option came about back in the 70s when all people, this was before they traded through online brokerages. This is back when they had stockbrokers or option brokers. And I'm convinced that the option brokers came up with the term to make it sound better than saying losing a position. So let's say that you're buying a call and the market goes against you a little bit. Oh, well, we're just going to make an adjustment to roll down the call. That sounds a lot better than saying we're losing money. So I'm convinced that's where it initiated. Now, I think there's a spot for rolling a position. Right now, like today, for example, or yesterday, for example, I rolled some positions myself to get some more from my SPY calls. I rolled from June out to September, same strike price because, well, we never move anymore in the markets, it sure feels like. So I think there's a spot for rolling. But if you're just rolling a losing position, I really believe, Alan, that the term was invented by stockbrokers in the 70s. I can't prove this, but I believe it was invented by brokers in the 70s, trying to make it sound better to their clients. That way their clients, after they go back to their spouse, after their wives, they can say, oh, well, yeah, we're down, but we rolled the position out to a further time frame. So that way they at least sound smart to their wives. And the stockbroker, back in the day when commissions were $1 million a trade, still made money. The client felt better, even though the market was going against them, and everybody won except for the bottom line and their accounts.
Mm-hmm. Yeah, I mean, but their rolling doesn't have to be because of the loser. A lot of rolls are just rolling hedges, continuous hedges, things like that. It's not just I'm rolling a losing trade. A lot of times people roll hedges, they roll covered calls. There's lots of reasons to roll besides just losing. I'm not a fan of rolling just to forego a loss. I think that's a losing idea, but that's kind of where I am.
Totally agreed.
All right, so here's a question for Uncle Mike. All right, this is from Evan. All right, Uncle Mike, I'm loving the Apple July 130-140 call spread. What do you think about this, both for an earnings play as well as for some longer-term bullish exposure to Apple? What are some other bullish strategies you could you would think about, not recommend, for a modest 10-point rally over the next 3 months?
Well, I don't know if I necessarily like that one for the earnings, because right now with Apple, as we're recording this, it is Thursday and Apple earnings come out on Monday. So as of right now, Apple closed today at 129.67. So just give or take, if we look at the straddle for next week at the 130 level, right now the 130 straddle for next week is trading at upper sixes, so about 670. So in looking at that, I think that if you're going to play just the earnings, I'd recommend just, if you're going to play the earnings, then play the earnings. I would probably do a call spread for next week as opposed to a couple months from now in terms of the earnings. In terms of playing Apple over the next couple months, I think that strategy is a great strategy. In terms of Apple itself, it's kind of one of those ones to where I'm not putting any new money into Apple right now. I am basically just hanging on to Apple with what we have and some of our gains, and it is going to be very tightly hedged going into earnings on Monday, just because of the fact that it's at a level right now to where I know, just for those of you that have listened to the show for a couple of years, Mark would say Apple has this, and this. And then my argument back to them would always be, well, it's Apple, and it would go up, and no one understood it. But now it's the point to where even I'm having a hard time with the argument, well, it is Apple. We're approaching the $1 trillion mark with Apple. It has a ways to go before it hits the $1 trillion market cap. And I think that's going to be, it's getting pretty darn big, and rightfully so. Apple has changed the world over the last 10 years. There's no question about that. But I don't really see the iWatch and the iCar or the things with which they have putting them into the multi-trillion-dollar level.
I'm not a believer in the iWatch, and it sounds like you're not a huge believer either.
No.
I wish Alex was here so we could ask him about it. But, I think, I know they've got earnings going up. With the way people trade Apple, the one thing that's nice about call spreads is that, there are all those fanboys that buy way out of the money calls because they think Apple's going to infinity. So a trade that can work and can be kind of effective for a move is kind of creating a risk reversal via an in-the-money call versus a out-of-the-money call. And you end up getting a synthetic collar play on relatively inexpensively. That's one of the plays that I like in Apple. The other thing that I like is kind of bullish butterflies, and again because of that skew. All right, and then this is just a quick comment from at Mark Brandt 1KM, and it said at option block. All right, I got even smarter about options. Again, the gift that keeps on giving. Go option block. Thanks, and I just want to say thank you, Mark, and we're glad that everyone likes the show. So with that, let's move away from all this awesome listener mail and into Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, welcome to Around the Block. And if you can't figure out what this is, then you need to pick up American colloquialisms. Mike, what are you looking for?
Just earnings, just to see what's going on with everything. Watching all the big names coming out. So curious to see how things go. Other than that, I mean, we have a relatively low VIX right now, yep. Which it can always go lower, of course. So just watching the earnings and seeing how everything plays out. Yeah,
I'm with you. I think we're in what I think is going to be the last time to get a relatively inexpensive hedge off in 2015. I just see some more January, February type behavior out of the market into the summer with the Fed keeping everybody in the dark on exactly what they're going to do. And so the ability to kind of go for that to get relatively inexpensive premium, I think is a real gift. Then we've got American Airlines, Xerox and Tyco tomorrow, and Apple on Monday. Woohoo!
Excitement! Can't wait.
All right, and with that, Mike, what have you got going on over there at RCM Wealth Advisors?
We have an event coming up in Chicago on May 5th. For more info on it, stop by our website at rcmfutures.com. We'll be talking about futures, alternatives, and all sorts of fun stuff of other ways to invest your money besides mutual funds.
Where is it going to be?
It's actually going to be at CME headquarters, 20 South Wacker Drive in Chicago. Check-in is at 3:45. First panel will be at 4:15. So go to rcmfutures.com to find out more information.
Now, if people come, are they going to get to meet you?
They will not meet me that day, but there is a slew of other people that they will meet that they definitely want to meet.
Awesome. All right, Mike. Well, that sounds like a great opportunity. And this gives me a great opportunity to say thank you for listening to the podcast. And until next time, for Mike, the Mountain Man Tucson, I'm Mark Sebastian. This is the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.